What if we told you that the world of Wall Street was once shrouded in a mysterious web of fraud and deception, and that the juiciest deals were based on schemes and manipulations orchestrated by some of the biggest players in finance? It's true. And in this video, we're going to reveal to you the true mechanics behind Wall Street's most notorious scam involving the so-called Wolf of Wall Street. Yup, it's the same one where the famous Hollywood movie was based on. One of Wall Street's most infamous scams is a thrilling, yet sometimes shocking narrative packed with high-stakes gambles, daring investments, and outlandish schemes. And it's all calculated carefully by the biggest sharks out there. We're talking about Jordan Belfort here. Can you believe he actually managed to make almost $1 million every week through some shady methods back then? Before we get to it, here's something you should know. According to Belfort himself, the movie was kind of based on the book, which was also loosely based on reality. The book intentionally left out a bunch of details that could be seen as proceeds of crime. And the movie, well, it skipped over some stuff too. You see, Martin Scorsese, the director, was more interested in showing the lives of those involved in organized crime rather than digging into the whole fraudulent stock market angle. Now let's talk about what happened. Before the turn of the new millennium, buying stocks wasn't as easy as logging onto a website and entering a ticker symbol. Nope, you had to actually talk to a real person, specifically a stockbroker. You'd give them instructions on which stocks you want to buy and sell. And if you wanted to know the latest market updates, you either had to wait for the next day's newspaper or ring up your broker. But in reality, most of the time, it would actually be the other way around. The stockbroker would reach out to their client, giving them advice on which stocks to buy or sell. The same idea goes for gathering information about the stock market. Times have definitely changed now, right? Nowadays, all you have to do is enter a company's name into Google or any other search engine and boom! You get the stock prices right away. It's that simple. Well, here's the thing. As Matthew McConaughey pointed out in the movie, stocks are just plain unpredictable. He said that even folks like Warren Buffett, not to mention stockbrokers, can't really say for sure if a stock will go up, down, or move sideways. So why do brokers still act like they can predict the market? The answer is simple. They get commissions. Whenever a broker makes a trade, they get a slice of the pie. We're talking about real cash in the form of commissions. By helping with these trades, brokers earn some pretty substantial commissions. In today's day and age, we're used to the idea of zero commission brokers. But it wasn't always like that. Back in the 90s, it was pretty common for trades to come with costs as high as 2% of its overall value. Usually, a stockbroker gets 1% of the transaction, and the firm they work for gets the other 1%. So, if a stockbroker managed to convince someone to buy $100,000 worth of stocks, that's a cool $2,000 in commissions. Even if only half of that ends up in their pockets, it's still huge, right? Especially if you consider that it's the commission they get from only one person. This is where Belfort enters the picture. Belfort's career really took off when he got laid off from his job at LF Rothschild, a stock brokerage in New York. Afterwards, he found another gig at Investor Center and then went on to work for a bunch of other similar companies. The movie really captures how these companies operate. Over-the-counter or OTC brokerages, in contrast to exchange brokerages like LF Rothschild, where Belfort once worked, operate in a distinct manner. These brokerages operate more like call centers, you know? They have these small teams of brokers who make cold calls to potential clients and convince them to invest in specific stocks. And since they don't involve the services of exchanges, it means they bypass a lot of the regulations and oversight. This means companies can just go directly to these OTC firms and say something like, "Hey, I need $5 million to fund research and development on this new technology that can be used for both military and civilian purposes." And you know what? The stock firm can agree, but they'll tell them that they'll keep 50% of the funds they raise. Now, some of these companies are just desperate for funding to bring their ideas to life, so they'll agree. But there are also companies who also try to scam their investors by misusing the funds they raise. Now, unlike the OTC brokerages, exchange brokerages facilitate trades on public exchanges and employ teams of brokers on the floor of the New York Stock Exchange. These brokers execute trades on behalf of their office-based colleagues, who, in turn, relay trades from their clients. Although the system in exchanges still had vulnerabilities to unscrupulous behavior, like stockbrokers pressuring their clients to do excessive trades to boost their commissions. The exchange had some control over all participants to prevent excessive misconduct. For instance, If the exchange found a stockbroker or firm acting in a way that harmed its reputation, it could remove them from the trading floor. This ensured the integrity of the exchange and protected against any potential harm caused by unethical practices. The impact of such a measure on stock brokerages would be absolutely devastating since their main business is all about executing trades. Exchanges have also implemented stringent regulations to evaluate companies' eligibility for listing. This involves conducting thorough financial statement audits, performing comprehensive background checks on management, and even ensuring that direct communication with their head offices doesn't unintentionally reach the CEO's relatives, for example. Before we go back to Belfort's story, if you're loving this video, then make sure to subscribe and leave a comment saying I subscribed, and we will personally reply to your comment. Now, that whole 50% number for OTC brokers was just made for the movie. The truth is that those brokers probably only made a modest profit of 10–20% on those trades. But if you think about it, a company that has to offer such a hefty stockbroker commission just to raise funds may not really be worth investing in, right? And that's where Belfort saw his opportunity. He and his colleagues resorted to using high-pressure sales tactics on naive investors. They would use fear and manipulation to convince their clients to buy stocks that were actually worthless. And because the stock market can be unpredictable, some of those stocks actually ended up rising in value, giving the impression that Belfort was a genius investor. So he went on to establish this small brokerage firm called Stratton Oakmont. This firm had the capability to trade both over-the-counter and exchange-listed companies. And eventually, they acquired the entire firm and made some significant operational changes. Now, here's the interesting part. While Belfort was making loads of money by selling low-quality investments to uninformed investors and keeping the profits for himself, he wanted even more success. So he put together this team of stockbrokers who would vigorously promote any stock he told them to. Before placing the order, he would reach out to his reliable connections who were not affiliated with his firm, but he deemed trustworthy. These connections, whom he nicknamed rat holes, would buy a significant amount of stock in a small-value company, preferably one with a market capitalization of less than $100 million. Once they acquired a big portion of the company, he would tell all the brokers on his sales floor to sell the stock to anyone who wanted to buy it. The resulting buying frenzy would drive up the stock price, making it more attractive to new investors. These investors would then be enticed by statements like, "Hey, this stock has doubled in value in the past week. Invest now, or you might miss out." Once the stock reached a certain price level, Belfort would tell his rat holes to start selling. But while this was happening, his firm would make it incredibly difficult for their regular clients to sell off the stock. He would tell brokers to completely ignore phone calls they get from investors, as they assumed they were trying to sell, or even purposely mess up trade orders. This smart move let the rat holes quickly get out of the situation, while regular investors were left scrambling. This meant when the general public started selling off their stocks, the price would inevitably drop. And then the rat holes would give the profits they made to Belfort, and he would then let these rat holes keep just a small portion of the profits. This scheme was taken to new heights when Stratton Oakmont started taking those small value companies public. An initial public offering, or IPO, happens when a company first gets listed on a public exchange. The main advantage for the business is that it becomes easier for them to raise capital from public markets. To make things smoother, companies often bring in underwriting firms that take on some level of risk for the whole operation. The underwriting firm's main job is to ensure the success of the IPO. By this, we mean selling all the company's desired shares at or above the agreed-upon price. Usually, companies would go to investment banks for their underwriting needs. But at its peak, Stratton Oakmont managed to persuade a few companies to get their services for that purpose. So, here's the thing. Belfort would strategically tell his rat holes to grab some stock in a company before it went public. Then, once the company made its big debut on the public market, he'd get his team of brokers to spread the word about the IPO to everyone they knew. This sneaky move would actually drive up the stock price, just like it had in the past. But this time, the company's listing on the public market will catch the attention of investors who had no idea that Stratton Oakmont even existed. When they hear about a whopping 50% increase in the value of the IPO right off the bat, they likely won't resist jumping in on the action. The rat holes were pretty clever, taking advantage of the stock spying frenzy to secretly sell their stocks and make huge profits. Belfort came up with this genius plan of merging unregulated over-the-counter operations with the public's trust in traded stocks, creating the ultimate money-making scam. It's called pump and dump, and it's how he made his millions. Pretty wild, right? Even though the jig is up for him, pump and dump schemes are still here. But now that you're aware of this scheme, you have the advantage. And if you found this video useful, then you'll love these. And be sure to like this video to let the YouTube algorithm know you'd like to see more videos like this one.